Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look through Twitter, see what people are sharing on social media. I'll sprinkle in my financial opinions as we go. It's going to be related to three topics: wealth building, financial, and or commodity topics that we'll be covering. And we'll dive right in here and see what people are sharing. Follow me at finding_finance for Twitter. And if you want to join our community, finding-value.com, we do have a really good discount going on called Holidays for both the monthly and yearly subscriptions, just an FYI. So, Paulo Macro, someone wanted me to comment on this. It's a thread, and you know what? I can do that. It says, on uranium equities, I've had the chance to think about some mechanics and flows involved here, and I fear people need to be much more cautious in the near term. Note, I'm not talking about the U308 spot price. Everyone, including utilities, CCJ, KAP, are short. It says, for starters, there's URANIUM and URNJ ETF selling. This has to do with the PFIC status of underlying holdings, not just SPUT, but many of the miners like NXE and whatever. Capital gains from index rebalancing, etc., etc. He's got all this stuff. So lots of technical damage from mistimed dividend announcements, but it gets worse. I was blown away when I saw it, but it's right there for all of you to see. And there's a 58 million in cash. I don't know what this means here. Cash equivalent minus 58. Maybe there is some selling. Okay, maybe they're doing rebalancing. Who knows? So beyond the damage done to retail with options expiry and the initial rebalancing, smoking the largest ETF names, etc., etc. Guys, in all honesty, this doesn't bother me at all. It's just an opinion. And someone wanted my opinion on it, and it's like, I don't need an opinion on everyone else's opinion. You need to go back and say, why do you own uranium? And are the underlying market conditions good for uranium to thrive under? That is really the questions that you should be answering. The opinions of most of these people, it doesn't matter to me. I don't care. I mean, Warren Irwin thought there was what was it, like £1 billion or something, and that uranium is in no short supply, etc., etc. I hate to break it to you, but the market conditions matter more than the actual supply of uranium and the way that money flows in the system. It matters more than what most of these people have even brought up. Now, is there technical damage? No, not in my opinion. Not on the charts that I see. It's not in URNM, URA, or any of those. So I don't see like this huge technical damage that people are talking about. So here's URNM. Yeah, there's a little bit of selling pressure. Could we get a pullback where this pulls on back? We very well could. But I'm not trying to time the short term. So if you take a long enough time frame, it just doesn't matter, guys. Even if this were to pull back to 38, okay, so what? What if it pulls back to 34? Okay, it's a great buying opportunity. I'll buy more URNM if that were to occur. The problems haven't been solved in the market, and we're going to get more inflation at some point due to more homes being built. And if you guys looked, the housing starts rocketed higher just recently, 1.5 million housing starts. So all I'm going to say is this, guys, there are going to be a lot of people that get these market conditions completely wrong. Completely wrong. Now, I'm not saying that I'm going to get everything right, but I think the majority of people are going to get it wrong. All the housing bubble people, they have it all wrong, in my opinion. All those people that think we are in this gigantic housing bubble and it's going to just crash, I think they're all wrong. That's my opinion. Is this guy wrong? I don't know. I'm not trying to time the short term. All these people who are trying to time the short term, most of the time they get it wrong. So am I going to try to time the short term? No, I'm not going to do it. Is there strength in the uranium spot price? Yes. Are the equities cheap to the uranium spot price? Yes. Developers are moving faster than, producers are going up faster than developers, which are going up faster than the explorers. That generally is an indication of being very early in the bull market of uranium. So we can have pullbacks as we go, but we're early, in my opinion, in this uranium bull market. We're not late. So would I care about what this person's opinion is? I can care less, dude. It does not matter to me. So what am I going to do? This is my strategy. It's not so much about making predictions and getting predictions right. That's not my strategy. My strategy is to identify what's cheap, to identify where we're at in the market conditions. We're still early. We haven't peaked in a hyper supply phase of real estate or anything like that. The demand and supply is still in favor of a supply shortage. So there's nothing that I can point to or look at that would make me sell shares in my commodity companies for the long term. Now, in the short term, could there be a pullback where we get a slowdown in the market? That is where we could. Generally speaking, slowdowns generally occur when you peak in interest rates, the Fed funds rate, it pauses, and then it starts to come back down. That is generally where a slowdown could occur. Now, if that was the reasoning behind this, okay, that makes sense to me. But I still wouldn't sell, because now you're trying to time a short-term market movement, and it may or may not work in your favor. So all I do with my strategies is stay long, hold long. If it pulls back, I get another buying opportunity where I can buy more, because the ratios are all good for the uranium equity still. Would I buy at this exact moment? I think there's probably better opportunities in the market than uranium at this exact moment for a lot of the equities, not all the equities, but a lot of them. One could argue that. And given where the yield curve is at and the potential uninversion and all these other things, there could be better opportunities somewhere else. And that's what I'm taking advantage of, are those better opportunities, in my opinion. But I'm not going to sell anything. I'm not scared. It's not going to scare me out of uranium to have opposing opinions. This is where it becomes infinitely valuable for everyone. You need to think independently of other people. I know what a lot of people do is they don't consider themselves experts. They want to hear from other people who are considered experts, and then they try to make a decision based off of hearing a variety of opinions. This is what I'll say. I make far more money. I have made and am making far more money doing it myself and thinking completely independent from everyone else. And what I do is I look at the entire world from a statistical probability. So I've taken a lot of statistics in college, statistics for engineers, linear regression analysis, quality control. You dive into all the mathematics that I've gone through, the calculuses, all that stuff, advanced stuff, math topics, differential equations, all that stuff, the physics, the chemistries, all that stuff, right? And it's really just saying, what are my probabilities and what strategies should I deploy to make money? And what I came up with is the three pillars: ratios, market conditions, and technical analysis. And those are the only three that give me what I think is an edge. And then I don't want to hear opinions. I don't want to hear this. I don't want to hear any of these opinions. I don't care about the news. It's all short-term noise. How are people positioning in the stock? What does it look like on the long term? Short term doesn't matter to me. What is the valuations that it looks like compared to history? And if you have good valuations, you have bottoming patterns that are coming up, and you're in the right market conditions. The market conditions is the real estate cycle, and it's going up for housing starts. That means potential liquidity into the system. Then it's all good. Now, there's only one thing here that is an anomaly when you look at history, that we have a variable today that we didn't have before. And that was a gigantic amount of stimulus came into the system during an expansionary phase of real estate. The expansionary phase of real estate was generally the liquidity driver. This was liquidity that came out of nowhere. Poof, it just came into existence and flooded the market with a bunch of liquidity. What exactly occurs directly after that? And what do interest rates, how do they react to that? You'd probably see the largest interest rate hike in the history of whatever. Are the interest rates too high for the expansionary phase of real estate? They probably are. And that's really what you have to navigate around. Are we going to get a slowdown between the stimulus money that came into the system, that liquidity, and more money coming from the real estate sector and the loans that are generated from the real estate sector? We also have fiscal spending that's just ridiculous on top of this. I think the near term is very difficult to project. I don't play the short term here. I'm playing the long game, boys. I'm playing the long game, and I'm going to ride it. We get a pullback, buying more shares. That's my opinion. 51% of Americans make a median annual salary of $75,000. They can afford a home that costs about $256,000 per the National Association of Realtors. The median home price in the United States is $431,000 according to the Federal Reserve economic data. Yeah, but I don't like, I read all this, guys, and I just look at it and I'm like, I don't know if the average person, by looking at all this data, I don't know. I mean, the average person, when you're in a massive shortage of homes, the average person isn't buying the house. So you could put the 25th percentile, whatever the 25th percentile makes, as a grouping, the family, whatever the top 25th percentile and above. I don't know what the combined income is of that family. That is probably where the cutoff point is on the lowest buyers. Then you're going to have to compete with people with gigantic down payments because the median annual salary can buy a house perfectly fine if they get a gigantic down payment, or if they get a bunch of money, like 50% of the home, paid for. That's probably what I'll do with my kids. It's like, why not? Why not give them an advantage? And if they're 20 something years old, I'm going to be old and probably with a bunch of money, and I'll be like, there's some money, take it. Like, it's not going to matter, or I'll somehow figure out ways to gift it to them or something. But I don't see how this is like that big of a deal. I used to live in San Luis Obispo. The average income in San Luis Obispo was probably $40,000 or $50,000. All of the homes in San Luis Obispo, they were all like 750, 800,000. Nice homes were going for $1 million plus. If someone looked at that from the outside and looked at all the data, they'd be like, there's no way that these homes could potentially cost this amount ever. And every single home in that area is way above the median average. I mean, you would see like trailer homes going for like 250 to 400,000. It's like, so I don't know. I mean, it just depends how desirable the area is, and maybe outside people are buying those homes. I mean, if someone said, would I go buy a house for 250, 300, 400,000 in San Luis Obispo today, and they would have and lock in that property tax. I think they could only increase it by 2% a year. I'd probably buy one. I probably would. I used to go to school out there. I'd buy a house, and it'd be a second home for me. But I'm not going to do it if it's $1 million or 750,000 or something like that. So here's Bloomberg. Top stock fund beating 97% of peers shifts from tech to energy. Yeah, that's where I'm at. I'm over in energy, precious metals, in those areas. For my friends from Traders Club Romania, why is it the US is doing QT and stocks are on highs, while in China they're doing QE, yet stocks are on lows? Because China has a demographic that fell off a cliff, and their real estate market took a major dive, which is a deleveraging event in China. It is deleveraging. So Their loans are going bust in their real estate market. That is like 1929 crash style. That is why they have to do QE to try to basically stop these loans from defaulting and foreclosing. Over in our area in the US, we've got the largest demographic coming into home buying years. So we've got massive demand for homes. We have fiscal spending. We have stimulus money that's still in the system. And they're trying to slow the stimulus money to try to ride that razor's edge to get inflation down. That's what they're doing. And now, since they're going to lower rates, you're going to see mortgage rates fall. And then you're going to see house prices take off again. Because you have a major shortage with the largest demand in history for homes that America has ever seen in history. And it's the most intense in 2024. 2024, 2025, in this general area is where the largest number of new home buyers are coming into existence, is over these next few years. That's your answer. It says gold divided by TLT ratio has seen a sharp move down, indicating that bonds are now outperforming gold. This setup looks similar to 2006. Back then, the Fed had paused rates as well, just like today. Here's the problem with these two scenarios. They are not the same. This was risen by stimulus money. This was risen by a housing market where liquidity was coming into existence from new loans into the housing market. The housing market was a bust in 2006, 7, 8. We had massive inventory increases of existing and new homes in for sale condition. I'm not talking about new homes that haven't been built yet that are in inventory, that are considered to be in inventory. They're not work in progress. These are completed homes, and they just flooded the market. This is stimulus money, in my opinion, that created this. We have not flooded the market in a hypersupply phase of homes like 2006. So it is different. We could have a stimulus overhang where we get a slowdown in the market. That is still possible. But I think that it's just going to go right back up when the rates go back down. That's my guess. And we have to watch housing starts, and we have to watch home sales and the volume of home sales and the loans. That's what we got to be watching. All housing new construction bears must bend the knee. It says, has there ever been a new construction boom that did not translate to a much stronger economy in 3 to 6 months? I think the answer there is clearly no. It says this economy and profit cycle is cleared for takeoff, and we see a massive move higher in housing starts. That move higher is inflationary. It's going to drive more liquidity with loans in the system if those homes get sold. And it is very strong for the economy. So again, it says, has there ever been a new construction boom that did not translate to a much stronger economy in 3 to 6 months? The answer is no. It's always been stronger. I like that one. Rock bottom entries, SILJ. So SILJ, November 27th, high breaking on volume, melt up confirmed. So if we have liquidity coming into the system, if the system is going to get more loans from the housing market and stuff, you're going to start to see gold and silver take off. Look at the volume here. We're getting some more volume in SILJ. And SILJ, the way that I draw this, I don't like the way he's drawn this. He only has 2 contact points. You don't really make a trend line only on 2 contact points. It would have been better to take this here and draw it through these. That way you've broken out, and you've broken out on volume. So in my opinion, we've broken out on volume, and we're already moving up. The trend line's already broken. The trend line he has drawn here is not a valid trend line, at least not yet. It could be in the future, though. Tavi says, with gold setting the stage for a significant move, 2024 is likely to be the year for precious metals. Investors remain gun-shy about deploying capital in the mining industry, which is poised to be one of the best segments of the market in the coming year. Silver, teetering on the brink of a historic breakthrough, has everything to become one of the standout performers in 2024. A new gold cycle is underway, and we are witnessing the early signs of what might develop into a crucial period of M&As in the mining industry, presenting substantial opportunities. This is the miners to gold ratio. We've got that long downtrend line that he's drawn here, and we're just underneath it. That's that line that I always talk about, where if we break it, it's the line for happiness for gold and silver mining companies. Guys, this is epic down here if we break this. That's what my son says. Look, hey, it's going to be epic. Is it epic? Yeah, it's going to be epic when this thing breaks. It is a huge opportunity. Now, it's not just that this is about to break it. Where the yield curve is located and how it's inverted and how low it is in the inversion is more justification to buy gold and silver mining companies and the physical metals themselves. Then you look at all the ratios, and all the ratios are dirt cheap. You look at the actual, here, I'll just show you guys. We can just go through it real quick. He's showing XAU to gold ratio. This is the chart he's showing there. It's just underneath it, ready to break to the upside. I call that, again, need to break this line for happiness for gold and silver mining companies. Then you go and you can look at all the different ratios for other stocks. Like we could do silver. We could do, this is the future price for silver. Look at where we're at here. This is your big downtrend line that we are about to break. You could almost say that we have broken this and we've got a bloody nose that is forming right now, right on this. It's a retest on a monthly candlestick basis, and then we're going to rip to the upside. It depends when that yield curve uninverts. And when the yield curve starts to uninvert, that's when the dollar drops. And when the dollar drops, send this. It's going to send it. Also, if we get liquidity for more loans in the system, this will eventually keep going higher because silver front runs that. So it's basically front running either stimulus money, lower rates, or liquidity in the system. It's front running all of that, and it's going to grow. This is the biggest chart pattern that I know out there. This is a inverted a cup and handle pattern, and we're about to break to the upside of this thing here at any second. So this is probably one of the best opportunities that I've ever seen in my life. And again, if you guys want to know how to play it, I'm showing you guys all the companies that I'm buying. I am very particular in what I want to buy. I don't want to buy crap. I'm not going to just shotgun this thing. I'm very particular on the companies that I hold, my entry points, and the patterns and fractals that these companies have before, and how they've basically moved last bull market in 2020, the surge higher, and last bull market from 2000 to 2011 in that time frame. I am very particular, and I've weighted these things with a high degree of reasoning and logic behind it. So this is something you guys don't want to miss. That's all I'm going to say. Do not miss this, please. This is going to be a big breakout. We also have seen, here's the gold futures. These are also up there. They are up there. And again, this generally takes off with an uninversion of the yield curve. I mean, we could still be early. Maybe we go sideways for longer. It's possible. Maybe even a few more months. Maybe even 6 months. We go sideways and the yield curve inverts further, and other, crude oil goes up, et cetera, et cetera. Maybe. I'm not saying that's my prediction. I'm just saying it could happen. You can even look at the gold to silver. This is gold to silver ratio. And I think we're going to go down here. I think we are going to compress. To me, the way that this thing kind of sold off hard and how it's kind of coming here, and then it goes right into a bearish engulfing here. That looks good to go lower on the ratio. Then you look at something like GDXJ divided by SILJ. These are the ETFs. And SILJ is at a very cheap level here. It'd be good to buy it in this circle there. It'd be good to buy it here and here. It'd be good to buy it here. This is at a very cheap level. And when this compresses down to a level that's more like down here, that's SILJ outperforming GDXJ. And I think GDXJ is going to be a rocket ship to the upside. Massively to the upside. And then you could look at all these different ratios that I've got for ETFs. And SILJ just looks fantastic. SILJ versus silver, it's starting to move on up. It is starting to move on up. People are positioning in this. you know what? This guy's positioning it. This guy. So, all the opportunities here are so vast. And I've looked at way more data than just what I'm showing you here. I'm just showing you kind of just the tip. I'm showing you just the tip of the data. And I'm not showing the iceberg underneath the water. You're just seeing the little tip of it. So opportunities are all across commodities. Could there be a slowdown? Could there be a recession? Could there be a pullback? People are always going to wonder that. They're always going to try to time the short term. I'm just going to say this, guys. It's very difficult to time the short term. All we can do is look at the ratios. We can look to see what's of good value. We can buy it, hold on to it. We can diversify the portfolio where we've got some things that go up in a slowdown and other things that do well in a non-slowdown, inflationary versus a disinflationary or deflationary environment. And that's all you can do. But as far as I can tell, commodities are looking good. Silver's looking fantastic. Gold's looking fantastic. Pre-GM metals are looking fantastic. And that they generally do well at the later stage of a bull market. So are we in the last innings? No, I think there's a lot to run. I think there's a lot more to run, and we've got a lot more houses that need building and a lot more liquidity that can come in the system. That's what I think. But that's where I'm going to end it, guys. I'm going to end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like, or you want to see my individual picks. I might do a training session soon. I'd like to talk to you guys, get your opinions, maybe on Discord, and see if you guys want to go through a training session. I know there's a lot of new people that have joined, and I can throw together a Zoom meeting. We can do it whenever you guys want to do it during the week, hopefully during the day at some point, and I can go through a training session, record it, and post it on the website for you guys. So if that seems interesting, definitely reach out to me. Maybe even the contact. I'll probably do it, probably not this week, but maybe next week. And if people have time off to do it, that would be perfect. Maybe I can do it not on Christmas Day or anything like that, but somewhere like a day or two before that. If you guys have it off, everyone can join. So that's what I've got. And we'll catch you guys next time. This is Finding Value.